great questions.
Live from New York this Monday morning. Good morning to you all. Three-day losing streak on the S&P, trying to bounce back by not even 1/10 of 1% on S&P 500 futures. Right now up by 0.04%. On the Nasdaq at the moment, up by almost 1/10 of 1%. On the S&P, 2 weekly losses. Can we snap that streak? There's the opening bow switch of the board and get to the bond market. Yields look a little something like this. On a 10-year, up 8 basis points. The yield this morning, 355.89. In the FX market, euro dollar holding on to 106, just like the 10 years, just about holding on to 350. 106.10 on euro dollar, up by 0.2 of 1%. And crude, 75.71, approaching 76, up by 1.9% on the session. 20 seconds into the opening bell, we are completely unchanged on the S&P, and I have to say on the Nasdaq, almost completely unchanged as well. One stock to watch at the open this morning, Tesla, and that stock is not unchanged. Elon Musk asking users in a Twitter poll whether he should step down as CEO, with more than 57% of the participants favouring his resignation. Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning, Jonathan. I mean, I've made a request for comment to Elon Musk. I've written to him to ask if he's going to follow through with this. He has not responded. Some of the other key names involved as well, we've written to and asked them if they're being serious in their offers to take over the role of leading Twitter. And of course, we haven't had any response. We're up 2% on Tesla. I'd point out this is a stock that was down 8 of the last 10 sessions as of Friday's close and was trading at a 3-week low. Also a gain of 1.5% now, John, is nowhere near sort of some of the positivity and exuberance we saw in the pre-market. It was interesting, the New York Times reporting in the last 24 hours that Elizabeth Warren wrote to Tesla's board over the weekend raising concerns that Musk's actions and leadership at Twitter had been harmful to Tesla investors. As you and I have been saying for days and days, I have a sort of sense of deja vu. Many retail and institutional investors voting with their feet, of course, and clearly they wanted some resolution to this. I would also just finally point out, John, that Musk did say in the heat of the battle with Twitter when he was trying to walk away from the deal that were it to go through, he had always planned to only temporarily lead Twitter as CEO and find someone in the long term. But he's now also tweeting that that person does not exist. That person, no one wants the job that's actually able to keep it alive, are his words. So one to watch.
Ed, we're going to have a longer conversation about this in about 10 minutes. Looking forward to it. Some Tesla bulls are happy about this, including Dan Ives of Wedbush. We're going to catch up with Dan Ives in about 15 minutes time on this program. Looking forward to that as well. Another stock, Meta, hit with antitrust charges. The EU antitrust commissioner expressing concern over its marketplace service, writing, quote, Facebook users have no choice but to have access to Facebook Marketplace. Abby has more. Hey, Abby.
Hey, John. Well, yes, the EU is continuing to go after Meta platforms. This, of course, after those antitrust watchdogs basically alleged this complaint saying that they allegedly squeezed out classified ad rivals by tying their Facebook Marketplace to their own social network. So basically a monopoly type charge. This latest complaint, of course, paves the potential for a change to their business model. A quarter of their revenues do come from Europe. This is advertising revenue. Not surprisingly, Meta is saying that these claims are without foundation. Now, what makes this so interesting, and there you can see that revenue breakdown and that big portion coming out of Europe. What makes this so interesting is the bigger trend here, of course, is the EU's crackdown on U.S. big tech, Apple, Alphabet, Amazon. Now, just a couple of weeks ago, if you recall, the EU told Meta, EU privacy regulators told Meta that they cannot use content data to provide personalized ads. The stock dropped about 8% on that. Right now, we have Meta down about 2%, so not as much. But on the year, though, John, this and other big tech companies losing a ton of market cap. Meta more than $600 billion. That translates to a 65% drop. You have to wonder if some are potentially bottom fishing. It's also interesting because today we do have the EU poised to settle with Amazon on a similar charge. And one bright note, maybe the EU is wrapping up another probe on the advertising pact between Meta and Alphabet. So many moving pieces here. But again, you have to wonder at some point, are folks going to be interested in Meta? Not today.
Abby, when does tech get a break? When on earth does it get a break?
Yeah, it's hard to know. I think one piece of it could, of course, be yields popping up a little bit today, but with that 10-year yield closer to 3.5%, it provides a little bit of room. But this looming recession, the possibility that profits are going to get hit, it seems as though tech and that monster rally out of the pandemic low continues to make them vulnerable.
Abby, thank you. I want to head back over to Ed Ludlow, who mentioned that letter from Senator Warren to the board of Tesla. Ed, can I come back to you on that? Because I think we need to build out that story just a little bit more. What is Senator Warren trying to find out?
Well, I think Senator Warren is trying to find out where Elon Musk's priorities lie. You know, from the reporting we've seen, of course, her interest is probably in the everyday investor. But as you and I discuss very regularly, the retail investor is not just a key holder of Tesla shares, but a key part of the story. You know, the mega bulls are those that have owned the vehicles. And in her letter to the board, you know, she basically points out, has there been harm done? If you look at the performance of Tesla shares since October 28th, when the deal to buy Twitter closed, it has trailed the NASDAQ 100, which is basically flat. Tesla's down in excess of 30%. The S&P 500 down, I think, around 17% in that time. Again, John, all I can tell you is that I wrote to Tesla's investor relations team because there's no mechanism for me to write to a press team. That doesn't exist, and Tesla's IR team has not responded. But I basically said, what is Tesla's and the board's reaction to this letter? Do you agree with what Elizabeth Warren is outlining, that harm has been done to Tesla shareholders because Musk has not been focused on that company?
Those gains fading this morning on Tesla, 150.59. Ed, thank you. That stock is up by 0.2%. Here are some dates for the diary. January 6th, payrolls. On the 12th, you get CPI. In January, day after earnings season really kicks off, the 13th, that's when you get JP Morgan. Mike Wilson of Morgan Stanley thinks it's all about earnings in early next year. This is what he had to say. Rates and inflation may have peaked, but we see that as a warning sign for profitability, a reality we believe is still underappreciated but can no longer be ignored. Mike Wilson, I'm pleased to say, joins us right now. Now, Mike, I couldn't ignore this in the note, and thanks for being with us. When you mentioned 2008, I think you get everyone's attention. You said this: we offer further comparisons to August 2008. Mike, can we start there? What are the comparisons between now and back then?
Well, good morning, John. Yeah, I mean, the main one that we're trying to put forth is that our earnings model, which, as you know, we spent a lot of time focused on, the spread between our forecast now and what the consensus is modeling for next year is as wide as we have seen since the summer of 2008. Okay, so in other words, we're looking for an earnings recession that could be as big of a surprise to the market as it was in 2008. Now, what we're not looking for, and I'll make it perfectly clear on this, is a balance sheet recession, a systemic risk fall off like we saw in the fall of 2008. So it's very distinguished, but it doesn't mean that there's still not a lot of price risk here. Okay, this is where we think we're out of consensus now, and where we have high conviction. So a year ago, it was really about the Fed and the normalization of rates, and now this is the second part of our thesis. As you know well, the ICE part is now really kicking in, and there's this sort of presumption out there from our conversations with clients that everybody knows that earnings are going to be bad next year, and the market's already priced it. And we're just putting this warning out for folks who assume the market is omnipotent, and it knows this. The market typically doesn't know these types of earnings declines before they happen. So that's the risk now, if we're right. Okay, we have conviction in our view. We could be wrong about that, but that's that's our work. And we think that this rally that we've had, which we identified and then got out of 2 weeks ago, we think that the technical price action last week was confirmation that rally is not only over, but it's about to exert itself on the downside again in a meaningful way.
Mike, can you explain what's behind that conviction? These are earnings for the quarter we're in right now. This is 4Q to be reported in the first quarter of next year. What's behind that conviction, Mike? What do you see that's developing that maybe other people are missing?
I don't think I see anything that's that different, John. It's just the way we put it together. So remember, our forecast I'm talking about is for the next 12 months. Everybody focuses on this quarter, but the market doesn't care about this quarter's earnings. It never does. It cares about what's going to happen over the next 12 months. That's what the market really focuses on and tries to figure out. In our model, we've got 30 years of history of this thing. It does a really good job of using data that's already out there, mostly top-down data. Some of that's survey data, soft data, as we like to call it, that leads to hard data. And, the R-squared on this thing is 80%, so it doesn't mean it's infallible, but it's pretty darn close. And when the spread is this wide, you really want to pay attention to it. When the spread's 5%, it's like, that's kind of noise. The spread's 25%. So that tells us that, this is probably not in the price.
Are you expecting to hear this in the guidance then pretty early on in earnings season? Mike, you know how the arc of earnings season works. The banks go first, then you hear from the tech players a little bit further down the line. Where would you expect to hear this guidance in the arc of earnings season as it kicks off in mid-January?
Yeah, I mean, that's what's different between the fourth quarter reporting season and the third quarter. And this is one of the reasons we backed off our bearish view in October was we said, look, we're not going to get capitulation on 23 forecast because there's no incentive for companies to guide on 2023 in October. However, now as you start a new year, right, they're compelled to say something because if they don't say anything, then people lose confidence that they know what's going to happen. So I think there is a much higher likelihood that companies acknowledge what we already know and what they know. Okay, companies do know that things are getting rough out there. You look at corporate confidence. This is one of the things we compared in the note today. CEO confidence is as low as it's been really in history. So that tells you their confidence level about next year is not particularly great, and that should come through in the guidance in January and February more so than it did in the last couple of quarters when they're not compelled to talk about the 12-month outlook.
Mike, I'm interested in where you think the earnings story may hold up. We caught up with Bank of America's Savita Subramaniam a little bit earlier this morning. She had this to say in a note she put out in the last week. She said, throw out the US recession playbook. It's different this time. Oil companies have capital discipline. Then she went on to say this about banks. Credit risk may be more evident at venture capital, private equity and long duration growth plays than at regulated banks. Mike, can you speak to that? Just the nature of the downturn you expect in earnings and the parts of the equity market you think will get hit hardest.
Yeah, I mean, look, the good news is, I would say, is the areas where the over-earning was the greatest, which is, core to our thesis about, the earnings reset. That's already happened. So like consumer durables, some of the technology areas, we've seen 25% revisions to next year's numbers. Now we think it'll continue to be bad because the over-earning was so extraordinary. And that's really the main message in our work, John, is that the margin expectations are just way out of bounds because companies had a windfall profit. That's not necessarily emblematic of one particular industry, right? I mean, COVID, well, it was a horrible human event. It was actually a windfall for corporate profits. And it was a windfall for investors. And that's all being wrung out now, first with rates and now with the earnings that were over-earning. So I think it's very broad. I don't think it's one or two sectors. I think we saw over-earning across the economy, and that has to play through. And I'll push back a little bit on the energy piece. I mean, I agree that energy is in a better position than it's been historically speaking because of that capital discipline. But if we actually end up having a labor cycle, we think it's 50-50 on that. That's when oil prices probably have their final move lower. The stocks won't trade well, even if the fundamentals haven't changed that much on a forward, curve basis of 2 or 3 years. The market isn't going to be willing to look through that. And that's generally our take as well, is we think people are being complacent about looking through an earnings recession that's going to be quite severe, and we'll see how they feel when we're in the middle of it.
So, Mike, can we talk about downside here? 3850 right now on the screen on the S&P. You're thinking closer to 3K as a bottom for next year?
And John, we've been very consistent about that, right? I mean, we've been in this sort of 3,000 to 3,300 range since really May when we put our mid-year outlook out. That's the path. And we think that's still the path. And I would say that we now believe we could get to the lower end of that path simply because you worked off kind of this bearishness in the last 2 months. I mean, the bear market rally we had did its job, right? Its job is to, it's like a 3-card Monte. Look over here, and then all of a sudden you forget about looking over on this one. And then that's when you get surprised. So, the setup's good for a finishing move to this bear market. That's the bad thing. The good thing is we're closer to the end than the beginning.
Mike, as you get more bearish on earnings, do you get more bullish on bonds?
Well, yeah, we've been bullish on bonds since the summer. We were probably a little early on that call, but it's worked out pretty well. I think, that's one thing that's different too this time, John, whereas like in 08, we're not going to have a systemic risk like we had in 08. In our view, anything's possible. That's our general take right now. That's good. However, the Fed cannot be as accommodative, right, as they have been historically because of this underlying inflationary issue, which is new in the investment community for the last 30 years. That's one other thing to be watching closely in the spring. How fast does the cavalry come riding in, even in the event of a labor cycle? I think they're going to be slower. They've told us that, and that could be the surprise and why we can get to those lower price levels on the S&P 500.
Mike Wilson, just awesome. This morning and through the whole of this year. Congrats to you and the team. I've said that a few times this year, haven't I, Mike? We appreciate your time this morning. Thank you. Mike Wilson there of Morgan Stanley. Coming up, Twitter users voting against Elon Musk.
The moves that he's making with Twitter are just destroying brand value. I think it should give anyone pause about the future of Twitter's trajectory.
Dan Ives of Wedbush up next.
My prediction for Twitter has long been that it's not going to die overnight, but that it will become more broken and more stupid. And I think that's what we're seeing play out. And that as a result, people will find other places that they want to hang out. They're simply not going to want to be on a service where the main character every day is Elon Musk, and it's simply tracking, what new shenanigans that he's gotten up to and what policies he's decided to invent out of pique and anger.
Twitter users voting in favour of Elon Musk's resignation after tweeting out a poll saying, should I step down as the head of Twitter? I will abide by the results of this poll. Well, the results giving shares of Tesla a boost in anticipation of Musk shifting his focus back to the firm. Ed Ludlow out of London with more. Hey, Ed.
Yeah, good morning, John. I mean, part of the downward pressure on Tesla shares since October 28th has certainly been the idea of key man risk. By his own admission, Musk has been much more focused on Twitter at times than he has on Tesla. Of course, the other part of the downward pressure is Musk selling billions of dollars of that stock, in part to kind of shore up his finances in buying the company. You'll remember as well, Bloomberg reported just in the last 10 days that some of the unsecured debt lined up to finance that package was swapped out in favor of margin loans secured against potentially Tesla shares or SpaceX shares, though we weren't sure if that actual part of the deal was completed. I think, John, for me, and I'd love your take on it as well, is, well, if he does step down, what happens to the platform? He did say originally he'd only lead the firm temporarily and then install somebody when he found them. But since launching that poll, and he said he'll honour the result, he's also said that there is no one out there that is willing to take the job and that can also do it in a way that keeps Twitter alive.
Well, I think he raises a good question, and it answers yours. Who is that person and where do they come from? Ed Ludlow, thank you. This conversation is going to go on and on and on into next year, no doubt. Dan Ives of Wedbush has this to say. It appears Musk's reign as CEO of Twitter will come to an end and thus be a major positive for Tesla stock, starting to slowly remove this albatross from the story. We remain our outperform rating and ultimately view this as a major step towards going forward, with Musk finally reading the room. Dan Ives joins us now. Dan, let's talk about that call from you. Do we have a leadership problem at Tesla or a macro problem?
I think right now it's really been more of a leadership problem. I think that's been a big overhang on Tesla, not just because of the essentially Musk using Tesla's personal ATM machine, but it's about the attention focused on Twitter as this twilight zone continues to, go on. And that's really been, I think, 70-80% of the sell-off in Tesla is Twitter driven.
Dan, why do you believe, though, just replacing him as leader at Twitter changes anything about this story?
Well, I think it's a step in the right direction. It clearly doesn't change the overall story because Musk still owns Twitter. It's going to go down as probably the biggest, I'd say, overpaid M&A deal in the history of tech. But you got to make sure that ultimately you get a pilot on the plane to navigate some of these challenges. That's going to be the key. It's been this black cloud over the Tesla story, but I just view it as at least a small step in the right direction. But the overall train wreck situation at Twitter remains unchanged.
So, Dan, let's talk about that just a little bit more. You saw the letter from Senator Warren, I assume, off the back of the New York Times reporting a little bit earlier this morning. Read as follows. In a letter to Tesla's board, the Democratic senator asked whether investors have been harmed by the billionaire tech mogul's time running the social network. Dan, what do you make of that?
I think the biggest overhang on Tesla, as we've talked about many times, is Twitter. I mean, it's a $44 billion epic mistake by Musk. And I think right now it's really been a quicksand situation. It's hurt the brand of Musk, which has hurt the brand of Tesla, because Musk is Tesla, Tesla is Musk. And I think right now, ultimately the clock struck midnight for investors, for users, especially a lot of the fiasco that we've seen over the last week. And I think, patience is really wearing thin here.
Dan, challenging macro environment, leadership issues that you've talked about repeatedly, yet you still maintain that outperform rating on a stock. Dan, why?
It's our view of where electric vehicles are going over the next 1 to 2 years and beyond that. I mean, Tesla continues to be the massive leadership position there. I think it's one of the most transformational companies along with Apple. So I believe it's oversold here fundamentally in terms of our view there. But no doubt in the near term, this is a Category 5 storm that's Musk inflicted that needs to end.
Dan Ives of Wedbush. Dan, we'll be in touch soon, no doubt, on the latest with regards to Tesla. That stock is up by only 1.6% off the back of this. The broader market down about 0.4% on the S&P. On the Nasdaq, down 0.8%. Talked a lot about that bond market. Yields up this morning by 10 basis points on a 10-year to 3.58, on a 2-year up 5 basis points to 4.22. With a sector price action, here's Abby.
Well, John, that yield action that you're outlining, it is one piece of the sector action because not surprisingly, some of those high growth, high valuation tech stocks, well, they're on bottom. Tech itself is down almost 1%. Communication services, some of the other mega cap technology names down about 1%. And I believe that the board we're looking at here, actually, I'm not sure what that one not classified is, but in any case, because I saw the minus 13%, we're down 1% for the worst sector. The best sector, though, energy up 0.5%. That has to do, of course, with oil. And then with yields higher, it's interesting that consumer staples, a high dividend yielding sector, it's up. Banks also being helped by yields higher. Now, one subsector that's not doing so well today, casinos down about 2% overall. This, of course, after JP Morgan is saying that the license renewals for Macau could prompt a sell-off. And this has to do, John, with the fact that over the last couple of weeks, up 65%, sell the good news.
Abby, thank you. That's the price action on a sector basis. Your trading diary up next. Day 4 days of losses on the S&P. We're down 0.4% on the S&P 500. On the Nasdaq, we're down by 0.75%. The backdrop in the bond market, yields up right the way through the curve. 2s out to 30s. Yields high by 5 basis points on a 2-year, 4.22. On a 10-year, up by 10 basis points, 3.58. That's the price action. Here's the trading diary. The White House holding its daily news conference, 2:30 Eastern. Earnings from Nike, FedEx on Tuesday, plus a BOJ rate decision and U.S. housing starts. Existing home sales and consumer confidence coming on Wednesday, followed by US GDP, core PCE, and another round of jobless claims on Thursday. And finally, if you're still around, personal income and spending numbers. UMich Consumer Sentiment Survey, durable goods to round out the week on Friday. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
TV and radio. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, December 19th. Here are the top market stories that we're following for you at this hour. Musk to exit stage left, maybe. Twitter users vote for Musk to step down as CEO of the platform. Tesla stock up almost 2%. We're going to try and find you the best trade. And unintended consequences. Europe is close to a gas price cap, which would cause upheaval in the global natural gas market. We're going to speak to Ed Morse, global head of commodities research over at Citi. Time to add risk. KKR's Henry McVeigh says inflation's peaked, so you can buy risk, while Morgan Stanley's Mike Wilson says a 2008-like profit drop could be in the cards. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Home stretch. I gotta say, volume is pitiful. It seems like we're the only people working right now.
The train was a little empty this morning, I have to say. The car park was a little empty. Yes, there are fewer services, but yeah, I think everybody's checked out. Which does make me slightly wonder whether or not there is the potential for things to happen this week.
Yeah.
A low volume environment can be dangerous ground. So you never know. This has been a year where I think we've all learned to maybe expect the unexpected.
Yeah, especially if you need to rebalance your books, if you need to rejigger for a 60-40 portfolio from stocks to bonds, like you need to kind of do that now. Is that going to create undue volatility over the next couple weeks as well? But thank goodness for Twitter news, because at least we have something really juicy to talk about.
Absolutely. I'm wondering where the genesis of all this started. Was it on this little trip that we've seen Elon Musk take to Doha? It looked like he got some pretty good seats for the World Cup final. What a great game. What a great game. I hope he enjoyed it. I hope he wasn't focusing on the future of Twitter and was focusing on what was going on in the pitch, because it was absolutely amazing. But yeah, he looked like he is fairly engrossed there, but clearly either there or on the way back something happened, a conversation that took place, I don't know with whom, but certainly something seems to have changed. So let's just talk about this poll that came out. 58% voting for Musk to quit as Twitter CEO. The numbers were high, 17 million users voting in this poll. I wish we could get some general elections that had that kind of participation. And Elon Musk saying he will abide by the result. So abiding by the result's kind of a difficult one, I think. Does anybody think that Elon Musk is going to be anything other than fully involved in what comes next? But Alex, I think your question of the day, if Musk exits, what is the trade? Is the right question to ask. Like, what do you think about that?
Me? Oh, I have zero idea. I have no idea. All I know is that I haven't tweeted in a long time, and I don't know if I should or I shouldn't. And I was at a conference last week where I was doing some speaking, and people were asking me, how do you use Twitter now? Like, do you think the information's real? Should we be on Twitter? And I was like, guys, I have zero idea. I genuinely don't know what to do about it as a journalist.
Well, it's good, because therefore we've got two people that probably do know, because I'm not sure I do either. Here in London, which is fantastic, I have to say I'm feeling a warm and fuzzy glow here talking about this story with a London bias. Ed Ludlow is here. That's amazing. He's in from San Francisco. And Alex Webb is here in tweed, which I think kind of sums it up as well, the gap between one and the other. Ed's wearing trainers.
I'm from San Francisco, though.
Alex is wearing tweed. I think this...
Like, genuinely, when I was in San Francisco, I was one of the smartest people, and when I'm back here, I'm like, the scrappiest.
Anyway, let's talk about what is let's talk about what's happening with Twitter.
Sure.
Ed, he says he's going to step down as CEO. What does that actually mean? Do you think he's going to step down as kind of the person who's in control? Is he going to stop being chief twit?
So to go back to the question of the day, you know, if you're an investor and you're watching this play out, you first ask yourself, do you believe that he'll follow through with it? You know, he tweeted after that poll was put out that he'll honor the result. I asked Elon Musk in recent hours if he plans to do that. I've made a request to comment for him. Haven't heard back, of course. But just as, you know, Twitter users have voted on the poll, investors vote with their feet, right? And
their money.
And their money. And there's a clear reaction in the stock. Yes, it's not as sort of energetic as it was in pre-market. I think we're up by 2 to 3%, right? But this is a stock that's been down 8 of the last 10 sessions. And as Alex has pointed out off camera, right, that there's a lot that's happened in the last 2 weeks and a lot in the news flow that you get the sense that the retail and the institutional investor was fed up. Investors vote with their feet.
Hey, Alex, do we know how this all came about? Like, was there a trigger for this? Because that would go a long way in helping answer the question, like, is this real?
We don't know for sure. I'm waiting on Ed and some of our other colleagues to do some stellar reporting on this front. But what we can do is look a bit at the timeline. And we can see that, as Ed pointed out, over the past week, 10 days, Tesla is down significantly. We can see Tesla's down, I think, 30+% since he took over as Twitter CEO, while the market itself remains broadly flat. So if you're a Tesla investor, you might be sitting there saying, I'd rather Elon doesn't spend as much time at Twitter. We can also see that last week, it was reported that he's out seeking new investment for Twitter, going to the same people who have a stake already or own the company already and asking them to double down. If you look at that and then see the consequence, there have been times in the past where Elon Musk has put out a poll when he's already made a decision about what he plans to do. I infer from that perhaps that maybe there are some people behind the scenes saying, we won't put money in if you're not involved. That is purely speculation, but it's not outside the realms of possibility.
What do you think he was doing in Doha?
Well, he's there with Jared Kushner, who certainly over the past few years, since being in the Trump administration, seems to have developed quite a rich network of investors in the Gulf. If he's out seeking investment, maybe he's there with Jared Kushner. Again, I caveat all this speculation, but, it isn't something that remains wildly outside the realms of possibility.
But Ed, to that point, I mean, he was looking to offload some stake in Twitter at around 54 something a share. Like,
right.
Do we make inference here? And also, like, for potential investors, like, do they want Musk gone or not? I wonder if, like, that conversation was transpiring.
Yeah, look, it's interesting because I don't know if Elon Musk is a football fan or soccer to you, Alex. And clearly he was at the World Cup final. I'd make 2 points that when Musk tried to walk away from the deal, which seems like a very long time ago, but prior to the deal's closing, he did say that he, being chief executive or the chief or leader of Twitter, was temporary, and he would find somebody new to come in if that person exists. Of course, we know he's followed up in the last 24 hours to say that there is no one that wants the job and no one that's capable of keeping it alive, which are his words. I'd also point out that the cap table of the private entity is complicated. Saudi Prince Al-Walid bin Talal is a significant shareholder, the second most significant individual behind Musk. The Qatari Investment Authority has almost $400 million tied up in it. And as I reported, what seems like months ago now, but was weeks, those that invested in the private entity were told that in a 3 to 5 year time horizon, Musk's plan was to take this company public again. Why am I saying all of this? Because A, when you're an investor, you want to know there's an exit and you can realize a return. But the whole point of taking Twitter private was that Musk felt wholesale changes were needed, not just to the structure of the business, but Twitter's underlying technology. And all we can talk about is what we know. Musk has said that he wants a technologist to come in and take this role, somebody who understands server and software technology, not necessarily an established operator. You remember that the former T-Mobile CEO, John Legere, tweeted, "Oh, pick me, I'll do it. I've got experience." And Musk just replied, "No."
So what is, if it is a technologist, what does the job description look like? I'm presuming stabilizing the ad base at the moment must be a challenge. But how do you get this, how do you put this kind of company on a meta multiple? What do you need to do to get it to that kind of level in order that you can realize the kinds of gains that investors, as Ed says, are ultimately looking for? The entry price was high. If you're looking to get out, presumably you want it to be higher.
You want to demonstrate growth and of the kind of level that Meta was able to post over much of the past decade, but a path towards the sort of 80% gross profit margins that Meta is able to produce. Now, Musk seems to have alluded to the idea that maybe some sort of super app is the way of doing it. There are a huge number of obstacles to getting to that point, whether it be, developing a payments layer, bringing all the developers onto the platform who would then build for your product, and thirdly, the regulatory piece. This is not something that regulators outside of Asia particularly like, when you fundamentally leverage strength in one business to generate strength in another one. That is ultimately the entire business model of a super app. So if that is the path forward, is there someone out there who could do it? But quite possibly. The irony is the CEO that he got rid of was a technologist. Parag Agrawal was the CTO, and so he sort of ditched one technologist for himself. Is there another one out there with the sort of
vision.
Ability, well, vision, but also the know-how to get it to the thing that's ultimately his vision? It's a very different question entirely.
Yeah. See, Alex, you're smart in London too. Don't worry. The tweet translates. Guys, thanks a lot. Ed
Smart
Ludlow.
in London sounds like a loaded compliment.
And Alex Webb. Thanks a lot, guys. Really appreciate it. All right, coming up, we're going to broaden it out here. Take a look at where to invest in 2023 with Maria Vasilou, Co-Chief Investment Officer of Multi-Asset Solutions over at Goldman Sachs. You take on risk or not yet? This is Bloomberg.
I think what's happened is you had a chief risk factor in the market. That risk factor was inflation, and it's come off the peak, and the market responded positively to that. I think as you get into 23, peak inflation is a little bit becomes your number two concern, and you get into a growth discussion.
So breaking news for you on Sam Bankman-Fried. He is preparing to be extradited to the U.S. as soon as Monday. He's been in a jail in the Bahamas, and he is preparing to be extradited to the U.S. as soon as Monday. There were lots of different legal cases on this. Maybe he could continue to fight extradition, which means that he could stay in the Bahamas for a while, or you can make an argument that there's limited legal defense, and therefore why not go and be extradited and go over to the U.S. So it looks like we are learning that he is preparing to be extradited as soon as Monday. Joining us on the phone, joining us here on set is Bloomberg's Sonali Basak. Hey, Sonali, is this a surprise to you?
It's not really a surprise. Remember, initially when we knew that he sought to fight extradition, that was before he was denied bail. So he has been in that Bahamas prison. As we know, very difficult conditions in that prison. Now that he will not fight extradition, as we know that he will be brought to the U.S. to be tried. That will be a process as well. We need to know that the prosecutors will try to prove beyond a reasonable doubt that he intended to defraud investors. Remember, he has been saying in his public statements that he did not intend to do any of this. So it will be a long road ahead, but not all that surprising that he will be brought back to the United States at the end of the day.
Will there be a bail option available in the United States? How will it work? What does his short-term legal future, do you think, look like, Sonali?
I think it's no short term. It's going to be a very, very long term. 8 criminal counts is what he's facing from the U.S. Attorney's Office here. And so those are very serious counts, as we know. I don't know in the short term that things get easier for him and how he's going to prepare the defense against, again, those 8 criminal counts. But we did know, for example, just a couple of days ago that the Bahamas did intend to comply with this extradition treaty. So him coming back here to be tried, of course, we'll see. No other government, to my knowledge, has brought any other case as well, but this is a global case.
Shonali, do you have any indication yet if there are others that are going to be named and charged in any way? Because on conspiracy counts, you usually need someone else to conspire with.
Yeah.
Have we been hearing anything along those lines?
Well, certainly Damian Williams has said publicly that this is just the beginning. And so that does imply here that others will face certain scrutiny, if not charges themselves. So the investigation here is really early on in its process. So we'll see what ends up happening when it comes to other members involved, not only at FTX, but in Sam Bankman-Fried's broader circle.
Shonali, stay there. We need to bring in Katanga Johnson in the Bahamas to get another take on what is happening here. Katanga, just walk us through kind of what we understand about how the process is going to unfold over the next few hours.
What we understand is that as Sam Bankman-Fried, who's now entered the magistrate's court here in Nassau, he had requested for a bail appeal hearing, but the hearing will actually be him saying that he will revoke his right to fight extradition, and we're hearing from sources who've spoken to him directly that he intends to be extradited as soon as today. This, of course, is the case that his lawyers will be making this morning here at the magistrate's court, which is a turn of events from what we saw last week, where he said he had intended to fight extradition. Whether this is a result of the conditions at the Fox Hill prison or whether it has to do more with a jurisdictional battle between the United States and the Bahamas is yet to be determined, but this is a change of strategy, it seems.
Yeah, and I should point out that you are outside the courthouse right now. Can you just walk us through anything you've seen, any details you're looking for? How do you expect the events to unfold over the next couple hours?
Yeah, we're seeing lots of people gather both outside and inside the courtroom, including members of the U.S. Embassy are present. I'm expecting to see his parents present as well. But I think this kind of support kind of shows that maybe the decisions around him being extradited might have come with some sort of deal with the U.S., at least 2 sources said. Whether that means he'll be granted bail or not, we have yet to hear that play out, but I imagine from our conversations with sources and the amount of support here today that whatever discussions took place sort of behind the scenes must have resulted in a better standing for him as he awaits some final decision after this hearing.
Guys, thanks very much indeed for the coverage. We're going to continue to stay on track with this story and bring everybody the latest. Bloomberg's Shonali Basak and Katanga Johnson joining us outside the courthouse in the Bahamas. That is a live picture that you are looking at coming from the Bahamas. If we see any significant movement, any developments that we think is necessary to bring to you, we will do that straight away. Let's return now to what is happening with the markets. Henry McVeigh of KKR has a call out that states that it's time to add risk now that US inflation has peaked and recession fears are, quote, less ominous. Joining us now to give us her take is Maria Vasilou, Co-Chief Investment Officer of Multi-Asset Solutions at Goldman Sachs. Maria, thank you very much indeed for your time.
Thank you.
The KKR call is to be maybe a little bit more bold. The Morgan Stanley call from Mike Wilson is to be a little bit more cautious, that the earnings story is going to become a little bit more difficult into next year. Which side of the fence are you on?
We are not ready to add risk yet. We don't think equity markets are fully pricing in the probability of recession. We've seen Chairman Powell being very determined to bring down inflation and focusing very much on labor costs, especially in the services sector, which, as we've seen, is where the bulk of the inflationary pressures are right now. So as he continues to hike into next year, year, I think we may see the terminal rate even going above 5.1%, depending on the persistence of inflation. And we don't think that equities fully price that probability yet.
So do you agree that we're looking at sort of the profit recession a la 2008? Like, is that how bad it's going to get?
I think it's going to be a different kind of recession than 2008 because there aren't really pathologies in the system in the same way we saw in 2008. We think that default rates are going to be much lower than back then because balance sheets are not overextended as they were back then, both on the corporate side and on the consumer side. So from that perspective, we don't expect financial crisis of some sort as we saw in 2008, but we do expect a recession.
Yeah, I think that's Mike Wilson's point as well. He's not saying this is a systemic event, but he is saying that you're going to see a downdraft in earnings similar to what we saw during that period. Maria, do you think that bonds and equities are going to remain positively correlated next year? And if so, what does that mean in terms of risk management?
No, they're not. We are going through a period that is quite extraordinary because typically when you are going through a period of slowing economic growth, central bankers step in to provide accommodation to the market. And usually when you're going through a period of falling growth, demand falls and therefore that's negative of inflation. So when central bankers add accommodation, that helps cushion the blow. But in this particular case, you're having a situation where growth was falling anyway, and at the same time we have very high inflation by Western standards, and so central bankers are really tightening monetary policy. That's really what creates the positive correlation between equities and bonds. As soon as rates start picking up and inflation starts normalizing, the relationship between equities and bonds is going to be restored. So we are actually not supportive of this bashing of 60-40, which effectively is a bashing of diversification at a portfolio level. We think diversification will continue to make sense, and there are a lot of things investors can do in a portfolio to protect their downside.
So, like what? Because it feels like this is the most telegraphed recession forever. Like, we totally know that this is happening. We don't know how steep it's going to be, but we know it's coming, right? And everyone seems to be positioned for a weaker first half, a better second half. Do you position for that? And if so, where can you still do that effectively?
This recession is going to be different than the previous ones.
But we know it's coming.
It's coming, but at the same time, it's happening at a time of significant geopolitical changes, a change in the sense of globalization. We have some partial deglobalization, some regionalization. We have a lot of potential external shocks that could really change completely the path of growth and inflation going forward, and also the path of policies. So the way we're positioned for the moment is carefully into Q1. We think equities have some room to fall from current levels because we don't think they fully price the probability of recession. But eventually, towards the end of Q1, potentially sometime in Q2, there could be great opportunities in equities. And that also has to do with the fact that the Fed is particularly focused on lowering the cost of labor. And that eventually is going to work to the benefits of equities because profitability will be able to recover.
Yep. Maria, private equity, private assets, or public assets?
Both private and public assets. I think the world we live in calls for a much more holistic approach to portfolio construction. We're going away from this segmentation of public markets construction and private markets construction. We think that all these changes in supply chains, in reindustrialization that we will see in certain parts of the world, in the deglobalization are going to present opportunities opportunities across the board. Some of them will materialize through public markets, some through private markets. So we're going away from this cookie cutter approach of value versus growth, this sector versus that sector, private equity versus public equity, and we want to look at portfolios holistically and see where the opportunities are. One thing is clear: we need to be dynamic, we need to be nimble, and we have to be very opportunistic in our approach.
All right, Maria, it's good to see you. Happy holidays. Maria Vasiliou, Co-Chief Investment Officer of Multi-Asset Solutions over at Goldman Sachs. Let's turn our eye now to D.C. There's a crucial vote today in the House January 6th committee. Members going to decide whether to recommend that former President Trump be prosecuted for obstructing a government proceeding and conspiracy to defraud the U.S. I want to get the latest now with Emory Horder. Emory, what are we expecting today, and what's the significance?
As well as potential for insurrection. So there's going to be a number of these referrals, and it'll be the first time, Alex, that it is the criminal referral, so a criminal prosecution that they are going to recommending. The issue there is this is just a recommendation. This is according to reporting, people telling Bloomberg, just a recommendation, which means it doesn't have the full weight of being held in a court of law. Potentially that's where the baton gets picked up. But what it does do is it does impact the former president as he deals with a number of issues, really, as he's trying to make this bid for the White House, especially after those midterm elections where most of his candidates did not perform well. There wasn't this red wave.
Yep.
His polls are really starting to suffer.
Would a conviction when it comes to insurrection preclude him from running for president, for being president?
Yes, that's a great question, Guy, because there is language in the 14th Amendment that if you are either president or member of Congress, you take this oath, and it bars you if you are said that you are part of an insurrection from holding higher office. So already this can make that path to the White House much more difficult, but really, it's really a slew of issues that this could just add to for the former president.
Yep. They're all mounting up. AMH, great stuff. Thank you very much indeed. We will bring you that news as soon as we get it. Bloomberg's Emory Horder joining us from DC. Coming up, the EU is racing to try and get a deal done to cap natural gas prices. Yes, this has been going on for a while, but winter temperatures obviously have maybe sharpened the focus. We're going to discuss all of this with Ed Morse, Citi's Global Head of Commodities Research next. We're going to get his take on what next year looks like. If you put a gas cap on, what are the unforeseen circumstances around that? I want to get that answer from Ed Morse. He is coming up next. This is Bloomberg.
an hour into the U.S. trading session. The highlight is just the massive lack of volume that we're seeing. Bloomberg's Abigail Doolittle tracking those moves. Abby?
Yeah, it's anemic once again, Alex, down 10% from the already anemic volume that we've had over the last couple of weeks. And right now, the S&P 500 really not doing all that much. It's going to be interesting to see whether the index follows the Dow, which is up just a little bit, up 0.4%, or the NASDAQ down. But the NASDAQ well off of its lows, at the lows down more than 1%. Much of this a yield story today. So the volume's, of course, a big deal because it really is a little bit of a snoozer during this holiday time period in terms of traders maybe being away. But yields, this is really interesting. If we take a look at a 10-day chart of the 10-year yield, we really haven't gone anywhere. Here we have the movement down and then back higher during the Fed meeting, and now we're basically just flat below 360, so well below the 4%. You would think that this might give stocks some room to move higher. Let's see whether or not that happens. But one of the big divergences this year, or more recently, I should say, has been the Dow and the S&P 500. This is really interesting because the resistance that we've been following, that bear market on the S&P 500, holding all year. You can see the S&P 500 in blue relative to that 200-day moving average. A brief move above it, but really below. But take a look at the Dow, well above its 200-day moving average, breaking out, holding it. This is similar to the NASDAQ Golden Dragon Index. It's also similar to the German DAX. When you have some indexes breaking out, you can't discount the idea that the S&P 500 is simply going to fall back down in. It looks that way, but let's keep an eye on the Dow. As for this divergence, let's take a look at what's happening beneath the surface. Because take a look at these two Dow stocks. JP Morgan Chase up 1.4% as yields climb on the day. Travelers, who knew just a couple weeks ago, an all-time high. Insurance companies, of course, doing well in good economies and bad economies. To the downside here, of course, though, it's big tech, some EU regulation, as you know, Guy, especially relative to Meta. But take a look at Apple and Microsoft, lower as yields pinch these big tech companies. When will they get a break?
Yeah. Tough going right now, certainly. The Twitter story, I think, is amazing, but the Meta story last week with the EU front and center. We're going to do a little set change. We're going to move cameras around a little bit. Basically, this means that I get 15 to 20 seconds to talk about what's happening in the oil market without being interrupted. Oh, there she is, by Alex Steele. You can't see her, but you can hear her. This is what is happening with crude today, Alex. 75.04 is where we are trading. The big chat over the weekend seemed to be that basically you've got a floor now under crude at around 70. The reason for that is A, the SPR, and B, what is happening with China. And I think that's the narrative that we now need to explore. We need to talk as well about what is happening with the EU gas cap story as well, and the impact that that's going to have on the nat gas market. But let's set up that oil market and talk a little bit more detail to what is happening right now. Natalia Kniazevich joining us now. Let's take a look back at what big banks are expecting from oil prices. Natalia.
Thank you, Guy. Yeah, so let's start with Bank of America. They expect Brent crude at $100 a barrel, WTI at 94, and potentially they say Brent can spike to 110 in the second half of 2023. They say downside risks are somewhat limited, but when it comes to upside risks, they can come from the European Union cap on Russian crude, potentially faster than expected recovery in Chinese demand, and probably a potential pivot from the Federal Reserve in the first quarter of 2023. The next one is Goldman Sachs. So they were saying that the US dollar has been the biggest story for commodities in 2022. In 2023, it will be all about capex. They've been talking about it for a while, but they said that unless we have sufficient capex, prices will remain high and very volatile. The next one is Morgan Stanley. This is the most bullish call. They see Brent at 103, WTI at 101. They see some oversupply in the coming months, but next year we will see undersupply. And for them, the biggest story is aviation recovery. I'm sure Guy Johnson will be excited to cover this.
Oh, yeah.
JP Morgan, they say for this year, natural gas provided huge returns for investors, but next year, all gains will come from crude, and investors can potentially usually see a situation when oil prices remain elevated despite a slowdown in the economic activity. And finally, the most bearish call comes from Citigroup. Not a big surprise. They expect Brent at $80 a barrel, WTI at 75. Downside risks are recessions around the world and, of course, choppy recovery in China. But cold snaps and more switching from gas to oil can provide an upside support. And one last point, we always talk about GDP as an indicator of where commodity prices will go. Citigroup team emphasized that this correlation between the GDP growth and demand for commodities will actually go down in the coming years thanks to energy efficiency and energy transition.
Natalia, thanks so much. Really appreciate it. Perfect setup. Natalia Kniazevic joining us there for Ed Morse, Citi Global Head of Commodities Research. He joins us now for more. Ed, you know, we're going to call you the bear in the oil market. What do you see fundamentally that others may not who are looking for 100 plus for oil next year?
We see a couple of things. I mean, basically, we see more supply than demand. We see demand growth at a meager 1.2, 1.3 million barrels a day. Yes, we have Chinese recovery, but we have the European economy in the doldrums and a U.S. recession ahead. The three largest economies in the world are not going to be adding that much oil demand to the market, nor will the emerging market countries. And meanwhile, we see supply as significantly more robust. And that even comes from the U.S., where there's a combination of lower demand, higher supply, and higher exports. So that's it, really, in a nutshell, with risks to the downside, in our judgment.
Ed, let's talk about the downside cap, though. We were talking about it a few moments ago. Does the SPR cap oil on the downside? Does Chinese demand cap oil on the downside?
Well, I think it's three things. It's the SPR cap, it's Chinese demand, which, by the way, we do not expect to see growing until sometime after the beginning of the second quarter. We think that story has been significantly overblown. And then it's, of course, OPEC Plus and what they may do to keep prices elevated. So, yeah, there is, we think prices would be much lower without the other pulls that are in the market.
Let's go to the supply point, though, for a moment, because a big part of it, the demand side is one thing. The supply part, you see that the U.S. Supply is going to come on strong, right? But then there's all the concerns about productivity. We've already drilled the most mature wells. Do you see that evolving differently?
Yes, we do. In fact, if we look at the latest real numbers provided by the Department of Energy and the EIA, it's their latest petroleum supply outlook, and they have, as of September, revised numbers up to about 12.3 million barrels a day. The stunning side of it that people keep ignoring is total supply coming out of the U.S. If you add to that over 6 million barrels a day of natural gas liquids, over 1,100,000 barrels a day of biofuels, about 1.5 million barrels a day of refinery processing gains, as our refining capacity has been used almost to its limits. We were supplying in September over 20 million barrels a day of liquids to the market, more than any other country in the history of the world. And we expect that 12.3 million barrels a day number, which, by the way, is awfully close to where the EIA is forecasting all of growth, all of the average production in 2020, 2023, and we think they're off by a good 400,000 or 500,000 barrels a day. So yeah, the U.S., we think, is a story of growth rather than a story of resistance to growth.
Ed, I'm just seeing a headline. I just want to confirm it on the EU gas cap. Just bear with me a second. Here we go. EU ministers agree on a 180 euro megawatts per hour gas price cap. What do you think of that number?
I think that's a silly number for a bunch of politicians to do right at the edge of winter. We're now pricing in today at around 110 euros per megawatt hour. We see that easily doubling. Yeah, inventories have been high. It's one thing to have a price cap on, it's another thing to find out where the supply is coming from. So if we have, we in fact have a magical change that's taken place in the global gas market. It is really global now. It's not bifurcated. It's not broken up into individual countries. It's not limited by destination restrictions and where LNG goes. Europe needs the LNG. and somebody's going to bid it well above that price if Europe puts that cap on and sticks to it. So it's almost a guarantee for blackouts rather than a guarantee for consumer content.
So, Ed, that's what I find so confusing. Like, longer-term contracts is one thing, but, for the spot market, where does the liquidity go? Like, if you're a producer or a utility, like, how do you hedge? I mean, this still feels like a massive naked short now for the EU on gas prices. What are going to be some of the trickle-down effects from this?
Well, the trickle-down effects are going to be, political on the one hand. We have another big cold spell. We have a polar vortex, and we'll have that price going up not only higher than the price cap, but significantly higher. The price cap is sort of like the electricity price cap, so they're guaranteed already. If you have an electricity price cap, that doesn't guarantee that the natural gas is going to be there to provide for the need to the fuel for making electricity. So it's a significant bind, which will have repercussions politically as well as economically. And yes, it makes for a market that is not reflecting the underlying basis of supply and demand, and people take advantage of that one way or another.
Ed, there was a piece in the FT, I think it was Friday, I think I read it over the weekend though, talking about the fact that the ICE exchange was maybe talking about removing the TTF contract out of the Netherlands for the simple reason that managing risk in these contracts is going to be really difficult. You're going to go from having a contract at one price, potentially then it gets hit by the cap and it goes to another price, as a result of which utilities, traders are going to have to put up significantly more in terms of margin. Do you think that the politicians understand the market implications of what is happening here or what could happen here? Do you think they're doing this in isolation? Have you heard that they're taking advice on this?
I can't comment on whether they're taking advice on it. I can comment on ICE being correct, that the TTF is not reflective of market conditions. On the other hand, the TTF price is really the base price of global gas at the moment. It's the price off of which everything else is benchmarked. It's the ARB relationship between East Asia and Europe, which is based on TTF. It's the ARB relationship between the U.S. Gulf Coast and Europe. It's kind of the source of the basic price. So if we get rid of TTF and there's no liquidity for any other European benchmark, and there won't be kind of immediately, the implications are relative disorganization, chaos in terms of, what is a gas price, what's the real gas price, and what's going to move it from one place to another.
Yeah, that feels really solid. That's definitely what we want to see into 2023. And before I let you go, I just want to get your take on the demand portion of this whole conversation when it comes to oil, though. Or I guess you could say for gas. What does the China reopening story do to balances for the oil and the gas market?
We don't know yet because it depends in part on weather. But certainly if we see an increase in demand from China, say order of magnitude 1 million barrels a day for oil, the real question, the balance, is what is that going to do to Chinese product exports? We had China before September 21 exporting about 1,200,000 barrels a day of products. When they went into the blackouts of September 21, they cut off all of their product exports. Those product exports at 1.2 million barrels a day, if they resume, if they get back to that level, then there is a balance in the market between the crude side and the refined product side that will make it less onerous for the market as a whole. So it really depends on other things, but in and of itself, that 1 million barrel a day increase in apparent demand shouldn't make much of a dent on the global product markets.
Ed, we really appreciate it. Again, to repeat, EU ministers agreeing on €180 gas price cap for the TTF contract. Ed, thank you very much. Happy holidays. Ed Morse, Citi Global Head of Commodities Research. Coming up, we'll stay on the China theme. It's betting on the private sector to really boost its COVID-ravaged economy. Details next and what we've learned about the COVID outbreak now. This is Bloomberg.